Welcome to the Bullion Signal Podcast. We're the channel dedicated to helping you understand the macro financial landscape, protect your wealth, and navigate a world of monetary uncertainty. I'm your host, and today we're tackling a critical question. Think about the global silver market for a moment. Picture it as this long, intricate line of dominoes, all standing perfectly balanced. Now, what happens if someone or something just nudges that first domino? What if a chain reaction has already begun that simply cannot be stopped? Well, one compelling analysis we've been studying argues that this isn't a hypothetical. It's happening right now in real time. So let's just get right to the heart of it. The central question we are exploring today is this: is the global silver supply chain fundamentally broken? We're talking about the entire system that pulls silver out of the ground and delivers it into our modern world, into our phones, our solar panels, our electric vehicles, and of course, into the investment assets that many of you hold to protect your wealth. Is that system cracking under an immense, unprecedented pressure? That's the theory we're going to break down. Now, to be perfectly clear, our mission here at Bullion Signal is to analyze these arguments, not to simply parrot them. So for this explainer, we're going to unpack the logic presented in this detailed analysis piece by piece. We're not here to tell you what to believe. We're here to lay out the evidence, the sequence of events, and the core reasoning, step by step, so you can see exactly how this powerful conclusion was reached, and then you can decide for yourself. So where does a potential collapse of this scale even begin? Well, according to the source we're examining, the first domino to fall wasn't a loud, sudden market crash that everyone noticed. No, it was something much quieter, much slower. A grinding legal and regulatory pressure campaign building for years in the world's #1 silver-producing nation, Mexico. When you look at this timeline, you start to see the bigger picture. This problem didn't just pop up out of nowhere this year. The analysis argues it has its roots all the way back in 2018. That's when the Mexican government essentially stopped granting new concessions for mining. Think about that. For years, the pipeline of future projects has been choked off. The more recent proposal to outright prohibit open-pit mining, well, that's just the final nail in the coffin. It's the legal capstone on a problem that's been festering for over half a decade, creating this massive, dark cloud of uncertainty over Mexico's future silver production. All right, so that's the first domino, a slow-motion legal crisis in Mexico. Now let's move to the second domino, because this is where the pressure really starts to build. While Mexico's problem is about laws and regulations, the situation in Peru, another global heavyweight in silver production, is much more visceral. It's immediate. It's physical. We are talking about an actual, literal chokehold on the physical supply chain. And this is a really critical distinction you need to grasp. There's a huge difference between mining silver and delivering silver. The mines deep in the Peruvian Andes can be digging up metal 24/7. But if protesters create a blockade on the southern mining corridor, the single most important highway for getting that metal to port, then those trucks loaded with silver concentrate aren't going anywhere. The source material has a great term for this: phantom production. It exists on a company's spreadsheet, but for the global market, it's a ghost. It might as well not exist. And this chart really hammers home why these two specific countries, Mexico and Peru, are so unbelievably important. We are not talking about small marginal players here. Together, these two nations account for more than a third of the entire planet's silver production, over 35%. So when both of them are facing severe simultaneous disruptions, one legal, one physical, the ripple effect isn't just a possibility. It becomes a mathematical certainty. This quote from the analysis really drives the whole point home. The argument being made is that this isn't some minor hiccup that the market can just absorb and move on from. Losing functional access to the production of your #1 and #2 global suppliers at the same time, well, that's a scenario the market is just not priced for. It's not a temporary disruption. It's a fundamental structural crisis. Now, these two supply shocks coming from Mexico and Peru are a massive problem all on their own, but the source argues they are hitting a market that has a deep, hidden vulnerability, a structural weakness that most investors and even most analysts completely misunderstand. And it's this hidden weakness that magnifies the impact of every single disruption, turning a bad situation into a potentially catastrophic one. And that hidden weakness boils down to this simple term: byproduct mining. The concept is actually very straightforward. It just means that most of the world's silver doesn't come from mines that are specifically looking for silver. Instead, it gets pulled out of the ground as a secondary metal, while miners are really focused on digging up much larger quantities of industrial metals, like copper, lead, or zinc. Now look at this breakdown. This right here is the absolute core of the argument about the market's inherent fragility. A staggering 72% of all the silver produced in the world is a byproduct. Let that sink in. Nearly 3/4 of the supply isn't mined on purpose. This means silver supply is not driven by the price of silver. It's tied to the economics and the supply chains of copper, zinc, and lead. Silver, in many ways, is not in control of its own destiny. So let's connect the dots. When those blockades in Peru stop the trucks, the financial news screams about the impact on the copper market, because copper is the primary metal. But here's what gets missed. For every single ton of copper that fails to reach a port, a certain number of ounces of silver also fails to reach the market. The silver shortage grows quietly, almost accidentally, in the shadow of the bigger industrial metals. It's metastasizing without anyone really noticing. Okay, so far, everything we've talked about has been on the supply side of the equation. How it's breaking down, how it's structurally weak. But that is only half of the story. The analysis we're examining argues that at the exact same moment that supply is collapsing, the demand side is getting ready to go into overdrive. We're talking about a demand shock. And this incredible demand pressure is coming from two of the world's economic superpowers, both pulling on the same end of the rope. On one side, the analysis points to China, which is behaving exactly like a country that sees a major shortage on the horizon. They're reportedly building up strategic reserves, and they are exporting less and less of their own production. Then, on the other side, you have the United States government actively pouring hundreds of billions of dollars through things like the Inflation Reduction Act and the CHIPS Act into green energy and high-tech manufacturing, industries that are all absolutely ravenous for silver. And if you want to see this demand in action, you don't have to look any further than a single sector: solar energy. The data highlighted by the source shows a mind-blowing 64% surge in silver demand just for photovoltaic cells in recent years. This isn't some slow, steady, predictable increase. This is an exponential growth curve slamming into the market at the worst possible moment, the exact moment the supply chain is showing signs of breaking. All right, we've looked at the supply shocks in the top producing countries. We've examined the hidden structural weakness of byproduct mining, and we've seen the demand explosion from global industry. So let's put all of these pieces together now and look at the final thesis presented in this powerful analysis. And this slide right here lays out the entire chain reaction perfectly. It's a cascade. Step 1, the first domino is the supply shock from Latin America. Step 2, that shock gets magnified by the market's dangerous reliance on byproduct silver. Step 3, this perfect storm on the supply side is met with an unprecedented acceleration in demand from both China and the US. And that leads us to the fourth and final domino, the moment the market finally wakes up to the physical reality and a panic-driven, violent repricing begins. And the argument is that this repricing isn't some future prediction, it's already underway. A 128% price increase in a single year is not a normal market fluctuation. That's not a healthy commodity cycle. The source contends that this is a signal. It's the market screaming that the physical shortages are finally starting to overwhelm and break the paper markets that have suppressed the price for so long. And this quote is so important because it differentiates what's happening now from everything we've seen in the past. The point the source makes is that this isn't just a temporary peak in prices that will be solved when a few new mines come online in a couple of years. The argument is that this is a permanent shift. It's a structural break because the fundamental relationship between supply and demand has been irrevocably altered. And that brings us to the final lingering question, which is really the core of this entire analysis. We've laid out the arguments for an explosive, non-negotiable, accelerating demand for one of the world's most critical metals. And at the same time, we've laid out the case for a crippled, structurally flawed, and breaking supply chain. The source leaves us all to ponder what truly happens when those two unstoppable forces finally collide head-on. That's a question worth thinking about. Thank you for joining us on the Bullion Signal Podcast. If you found this analysis valuable, please make sure you subscribe to our channel, give this a like, and share it with someone who needs to hear it. Your support helps us continue to bring you these crucial insights. And finally, a brief disclaimer. The content discussed today is for informational and educational purposes only. It is not and should not be considered financial or investment advice. You should always conduct your own thorough research and consult with a professional financial advisor before making any investment decisions. You are solely responsible for the choices you make. We'll see you in the next episode.